Welcome back. It's playing out according to script. We went down to around the 200 EMA. We saw a bit of a bounce of around 100 points odd. That's giving back a little bit. The crucial part is, can we hold on to the morning lows and see a bit of a fight back? Because there's crucial support at around that 17,360 odd from where we bounced earlier today. Well, let's focus on the space that's got the hardest knock this month. That's metal stocks. They have taken a knock. They're down close to around 15% this month. For the year, they're down close to around 21%. And in spite of all this weakness, JP Morgan, they have an overweight rating on a couple of these stocks. Pinakin Parekh, Executive Director, Metals and Mining, Oil and Gas, as well as Cement at JP Morgan India, joins us on the show. Hi, Pinakin. You've been constant that you've been quite bullish on the metal space. And for some part of the last few months, from November lows, well, it worked out pretty well. We have been seeing weakness on these stocks. Do you believe that it's a good time to get into them? And if yes, what's your preference between ferrous and non-ferrous?
Yeah, good morning, Nigel. So essentially what has happened is that good news for the economy has been bad news for the markets. While the recent bounce in economic growth in US and Europe and improving data points in China are good for commodities per se, commodity equities have not reacted as positively. We continue to focus on the China reopening. Steel inventories declined for the first time last week in China. And this is particularly positive for the ferrous value chain as we enter the China 2 sessions and expect more positive news flow to come out and support the economy.
Okay, so more positive on ferrous versus non-ferrous. Preference for ferrous versus non-ferrous, right, Pinakin?
Yes, we would prefer ferrous over non-ferrous at this point of time, especially given the China rebound.
Pinakin, let's focus on pricing then here in India. Chinese prices have moved up dramatically, I think from around $510 to around $660 odd. So there's been a big increase. Indian prices have moved up, but not in the same manner. Do you believe there is a good chance that we see higher prices here in India? If yes, what is the price increases you're working with from year on? And also compare domestic prices with international imported prices.
Sure. So to start with, the domestic Indian steel prices never corrected as much as the Chinese HRC export prices did. What you had a situation in the second half of last year was that domestic Indian prices were at a premium to landed Chinese steel prices. So to that extent, the increase in domestic prices has been muted versus Chinese prices. That is simply the base. Domestic HRC prices are up roughly 11% from the lows of December. At this point of time, we estimate domestic HRC prices at around 60,000 rupees a ton. That will compare to landed steel prices from China at roughly 64,000 rupees a ton. So there is a good 5-7% gap over here, and we would expect domestic prices to increase. More important is to see what Chinese prices do, because at today's coking coal prices and iron ore prices, marginal mill in China on theoretical spot cost will be loss-making. So we would expect more price hikes to happen in China, which should eventually flow through to the Indian steel markets.
Pinakin, hi, good morning. Let's come to the non-ferrous now. Hindalco, let's start there. I mean, on Friday it sold off, right? Big time, some 5% cut on Friday. Again, I mean, what's your thought process on Hindalco and the non-ferrous side?
So again, apologies, Prashant, we will not be able to speak on company-specific names. On non-ferrous, again, overall, the macro in China, if it continues to open up, it will be positive for non-ferrous as well, base metals as well. Inventories are low. Having said this, base metal prices tend to be more influenced by global investor flows versus non-ferrous versus ferrous commodity prices. So to that extent, any weakness in equity markets tend to flow through the base metal commodity prices. We have seen aluminum, zinc, copper prices sell off, even though on the ground inventories have been depleting. There have been production cuts in Yunnan in China because of drought. So you have a divergence between the fundamentals of the commodity and the prices of the commodity, more driven by investor fund flows, and that will influence stocks in the sector as well.
You do track the entire oil and gas space as well, CGD, downstream OMCs, ONGC. With Brent around these levels at $84 a barrel, what do you think the scenario would be for the oil and gas space? Which are the spaces to avoid? Which are the spaces you prefer under that umbrella?
Sure. So at this point of time, our house view is that oil prices rise from here. We are still looking for Brent to exit at $94 by the end of this year. That's more than 20% increase from here. Second quarter, we expect oil demand to surge globally, driven by China. 1.3 million barrels of demand increase as China reopens and travel picks up very sharply. So you should have stable to higher oil prices. At this point of time, within the broader complex, our view is still that downstream industries, basically refining, petrochem, where spreads should stay high, or spreads improve from decadal lows, as in petrochem's situation we saw in the December quarter. That is the space we would still want to be invested in within the oil and gas space. But clearly, we expect Brent prices to move higher from here.
All right, Pinakin, final question before we let you go. There's this NMDC steel plant, and it's getting a lot of interest from various steel players. The question is, how much will people bid for? I spoke to the management, and they said they have spent, before the steel plant gets commissioned, they'll spend 24,000 crores for a 3 million ton plant, which is 8,000 crores per million ton. What's your sense? How much would steel players be willing to pay for inorganic growth? Or how much are they paying currently on organic growth per million ton?
Sure, Nigel. So again, no company-specific comments over here. But what we would highlight is a couple of things. In India, the greenfield capex cost per ton of steel is roughly $1 billion for a million ton, which is basically get the land, set up the blast furnace, the coke oven, and the downstream capacities. Historically, we have seen multiple steel plants get auctioned under the NCLT process. So there is a valuation range which is available over there. And to buy any asset for a strategic buyer, it would come down to what is the time period they want to save in terms of setting up versus buying out. So again, difficult to answer what is the exact valuation one would look at, but clearly for a strategic buyer, the thought process is slightly different from, let's say, a minority buyer who's buying a share in a company.
All right. Pinakin, it's a pleasure. Thank you very much. Appreciate your comments and thoughts on the resources sector, as always, here on CNBC TV18. Thanks indeed. As we've been pointing out, it's not one way. We saw a sharp fall, a day's low near the budget day low, sharp bounce back, and now a sharp fall once again, all in the matter of, 40 minutes or so, right? So this is the market we are in at this point in time. Now, travel resumption and the wedding season in Q3 of FY23 provided a major boost to VIP industries. The luggage manufacturer witnessed strong volume growth of 25%. To discuss the demand trends in Q4 so far and the outlook for the business, we are now joined by Anindya Datta, Managing Director at the company. Anindya, great to have you with us here. Good morning. Thanks very much for your time. I believe, Anindya, you were running an exchange offer from the 1st of December last year, which ran till 31st of Jan this year. So, customers could walk in, exchange an old bag and get 2,000 rupees off on select VIP bags. Let's start our chat today with what kind of response you've seen to this offer. And if you can put those, if you're giving numbers, if you can put some context to those numbers with previous figures when the offer was not there. Go on.
Hi, morning. Glad that you have me over for this discussion. On the exchange offer, whenever we run an exchange offer, it's always a great number spike up that we see, because the average cycle of change of baggage is not very high, is high, and therefore an exchange offer kind of fuels that. So we always see at least an 8 to 10% blip over normal sales when we do an exchange offer, and that's what we are seeing right now. But the way you started that, this whole demand environment was even better prior to that, and it kind of only accentuated it further.
Okay, so there's a lot of things working in VIP's favor right now, I guess. Whether it's travel picking up, it's the wedding season booming, it is corporate travel back in a big way. Can you quantify all of this for us in terms of demand trends and what this means for your revenues as well? I think earlier you said you would get closer to about 2,300 crores in terms of revenues for FY23. You think you could meet that? Could you do better than that? And what's the outlook for the next year?
I think we'll come very close to the earlier outlook that we gave, around 2,200. Or maybe a little bit lesser than that. It's quite aggressive. I think we'll end up with almost about a 20% growth or thereabouts over the base year that we are considering, which is 2019-20. So overall, the industry is really sprung back this year from what we saw, the recovery that we saw in the previous year. On the base, when we have grown 15 to 20%, it's something that we had not expected in the beginning of the year. I think this is going to continue. The kind of travel and all the demand cohorts that works for us seems to continue as we speak, both travel, wedding, students travel, and also a bit of tailwind because of the unorganized sector yielding faster into the organized sector as we speak. So all this put together as of right now.
So you said, okay, around this 2,200 crores, maybe a little under that is what you could close the full year. But what about volume growth? I think now it's been about 25% in the quarter gone by. Things would normalize, I'm guessing, over the next couple of quarters. What would the average volume growth look like for FY24? What are you targeting?
So very difficult to put it for the full year right now because the demand environment, at least the speak around it, is quite volatile. So if we look at quarter one and quarter two, the first half of the year, I think the industry is going to grow anywhere between 10 to 15%, and I think volume would be also there about the same. And we would have an ambition of growing faster than the market to gain back some of the share that we had lost in the previous years.
What's the updated market share, Mr. Datta, and where is that headed in FY24?
Well, the market share is we don't have an accredited data on market share. It's more basis the numbers that comes out in the results that are filed. At the end of quarter two, we would be at about 41%. We are yet to get the numbers for quarter three for us to know where we are end of December.
But you think you'll get to the mid-40s?
Yes, eventually, yes. It may be a little slow burn for the coming few quarters, but yes, by the end of next year, we should be there.
All right, Mr. Datta, you started sourcing from Bangladesh, right? And that's what was helping margins. How much are you sourcing from, how much of your requirement are you sourcing from Bangladesh?
About 40% of what we sell comes from Bangladesh right now.
Okay. Mr. Datta, I think there was a fire in Bangladesh. Could you give us some clarification out there? What was the impact on your supplies? Have things got restored out there?
Yes. So one of the 8 factories that we have in Bangladesh has got burned down completely. Unfortunately, thankfully there has been no injuries or no harm to any people. It has impacted our supplies in the short term for sure. However, this is eating into the headroom that we had built very hurriedly in the previous year. So while there will be some impact in the immediate term in supplies, but we are gearing up in Bangladesh and in other locations in India to cover up for that factory, and should not be a big dent into our plans for coming year.
Anandya, just 2 questions. This 41% market share at the end of the second quarter, which you said, this is in which category? Is this in a particular price range?
No, this is overall in the luggage category. I'm not including, let's say, ladies' handbags in this.
Okay, but hard tops, soft tops, everything, right?
Everything put together, yes.
Right. Anandya, VIP is an iconic brand, right? We've all grown up with it. I recently was in the market for a piece of luggage, cabin luggage, and I spent an hour, 2 hours in a shop. And what I found, and this is just maybe feedback, right, is that, and when you are shopping for, I don't know, a cabin baggage, flyers are, numbers are at all-time new highs. We are above pre-COVID levels. So I'm assuming that is an important market, profitable market that you're sort of targeting as well. Is there any way to reduce the weight of the bags, the VIP bags? That is at least what I found, because that plays an important role, right? Because you can only carry, say, 15 kilos. And when customers are shopping, that becomes an important determinant. So you don't want to carry, you don't want the weight of the bag to be itself 3.5 kilos. You want it to be lighter. Go on. Is that something you're looking at?
No, of course we are looking at that, and that's been a constant endeavor. It's not been now that the consumer is seeking a low weight bag. It has over the years. If you see, the weight of the bag has gone down, and we would like to further make it go down while keeping the strength of the bag that it desires. Our R&D has been continuously working on this, and you may see some products more towards making the bags lighter come up in the next year or so.
Okay, all right. Well, we hope so, that the bags can be lighter so the shopping can be heavier, right? Thanks a lot for joining in. All the best for the future. That's VIP. But by the way, don't lose sight of the market. A lot of levels are being breached on the downside. The budget day low of 17,350 has been broken on the downside. The 200-day moving average has been broken. This is looking like a pretty ugly picture if you're a bull. Mitesh Thakkar of earningwaves.com joins in. Mitesh, I think it was just a matter of time, right, before these levels got broken. I mean, 6-7 days running now, the market has been under pressure. At some point, do you see a pullback, or do you think that, it could be a one-way slide even from here?
Pullback is a difficult thing to guess because it can happen any day, intraday basis, because we have been slightly oversold. My sense is that I think eventually we'll head towards that 17,000, 17,100 zone. I think that's the more important observation, and therefore I think rally should be used to keep creating or adding on to your short positions.
Any stocks that you'd want to look at? There is quite a bit of pressure actually on individual stocks. If in fact we can pull up the contribution plate, you will see that a big drag this morning is coming in from a lot of the IT names. Infosys is down, TCS, Tech Mahindra, Wipro are all down 1 to 2%. Any thoughts?
I have in fact the sell on Persistent right now, and I think as you rightly are highlighting, I think these stocks are clearly going through some kind of a breakdown. So Persistent, I would recommend selling with a stop about 48.50 for targets around 46.25. And I think most of these stocks, after having done very well for the last few weeks, I think now are in a pullback mode. So you will see some, gains being taken off from the IT stocks as well. And in general, I think, broadly, since the market is looking weak, I think they will not outperform now. They'll stop doing that. And I think they'll just be market performers. So they'll decline along with the markets. And I also have a buy call on NTPC. Sorry, I just covered that. That's a buy with a stop at 170 for targets of 179.
All right, Mitesh, thanks very much. Good speaking with you. Appreciate you joining in and running us through the picture right now. We are below the budget day lows. 17,353 was the low, and now we are at 17,334. The low has been made at 17,323. So, it was looking like that the morning we highlighted it, and now we are below those levels as well. Well, time for a quick break here. Manisha will be joining in, and she'll put the focus, the spotlight on the commodity space, what's happening there. We'll be back with that conversation in just a bit.
स्मिता आओ बेसो बेसो
स्कार्फ में भी पहचान लिया?
हाँ बोलो आज बैंक कैसे मनी ट्रांसफर
कर दी ऐप से।
तो एफटी
ऐप से
चेकबुक चाहिए होगी नहीं है ना?
मेरी शादी है। ऐप में आप नहीं हो ना, इसीलिए खुद कार्ड देने चली आई।
बहुत सरस है।
रिश्ता आपसे है, सिर्फ ऐप से नहीं। फेडरल बैंक, योर परफेक्ट बैंकिंग पार्टनर।
Invest once and enjoy guaranteed maturity with life cover with LIC's Dhan Varsha, a single premium plan for your family's security and prosperity.
अपने घर और कमर्शियल स्पेसेस को बनाइए अल्ट्रा मॉडर्न, इनोवेटिव, इको फ्रेंडली with quick installation. All this at the one-stop destination, Europatik.
Presented by HSBC. Knowledge Partner, Deloitte. Industry Partner, Vicky. Associate Partner, Reliance Industries Limited.
Sarah, this is your space.
Play it your way.
रेणु, अपना नया घर का सपना पूरा होगा। लोन हो गया।
पापा, हम अपने नए घर में कैसे रहेंगे?
अपनी नई कार में।
और ये कार लोन भी यूनियन बैंक ऑफ इंडिया से?
हाँ, अब घर और कार का सुनहरा सपना साकार।
यूनियन बैंक ऑफ इंडिया, अच्छे लोग, अच्छा बैंक।
बात सिर्फ मेरी नहीं, देश की थी। माइनस डिग्री में भी कॉन्फिडेंस प्लस में रहता था। वो जज्बा आज भी बरकरार है, सही मूव लेने के लिए, क्योंकि अब बात सिर्फ मेरी है।
सिग्नेचर ग्लोबल आपके इसी अंदाज को सल्यूट करता है। इंडिपेंडेंट फ्लोज फॉर द इंडिपेंडेंट यू।
Want dividend paying companies with a strong growth potential? Invest in the SBI Dividend Yield Fund. Hurry, NFO closes on 6th March. Mutual fund investments are subject to market risks. Read all scheme related documents carefully.
Welcome back. Not going well for the equity markets, but before we talk further about that, let's get a handle on what's happening in the world of commodities. Manisha is with us. Manisha, what are you looking at today?
Well, for a change, I'm looking at the tea prices, where we have seen prices continue to gain up. The tea inflation also shows on the higher side. The global prices have been inching on the firmer note as well. And there are 2 to 3 things that you should take note of. One, last year as well was a good year rather, and we saw an average tea prices gain up by 7 rupees per kg on an year-on-year basis. The second thing that you have to watch is the driest spell since the month of November in the key producing areas, and that tells you that the first flush, which is a premium first flush, this is the best tea that comes in, could get impacted in sense of quality and yield as well, and that has been keeping the prices higher in concern of scarcity there. The third thing is about the export numbers, and Indian exports of tea have been quite on the stronger side. We are looking at 18% of a jump up in the previous year on an year-on-year basis. When you look at the numbers itself, for the last year, the exports were at around 230 million kgs versus 176 million kgs that we saw in 2021 there. The per capita consumption of tea in India is still on the lower side at around 850 grams. So the markets do believe that there is much higher levels from here to capture on, and the tea demand could only be on the higher side. When you look at the export numbers within the Indian markets, the CTC actually is the 90% of the overall quantity at 1340 million kgs and orthodox at 110. So there has been a lot of push coming in from the Tea Association and the tea producers as well to ensure that there are more subsidies given for the CTC there. Another trend that really seems to be coming in for the tea is that the small producers now are 52% of the overall production market here at 697 million tons. So the tea estates or the listed companies, that number has continued to decline since 2005 here. So as of now, that is at 48%. But the markets do see that the smaller tea companies or the smaller tea producers, that number is expected to continue to gain on the higher side.
Okay, thanks a lot, Manisha, for that. Well, let's get back to equities now. The biggest loser of the moment is Bajaj Auto. It's down almost 4%. Things are not looking good as reports indicate that the company will be taking a 25% production cut in its export business purely because of the challenges that we're seeing over there, and that happens from next month. The production cut is due to uncertainties in export markets like Nigeria, as we know has been the case for a while. The company is likely to produce just around 250,000 units in March versus a production of 338,000 units in 9 months of this year. Now, we reached out to the management and they did say that, at the moment, this production cut is something that is ongoing for all two-wheeler exporters because things are looking very rough, and this has been the case for the last few months, so Bajaj Auto is not alone. Remember, the numbers for the month of February will also come out in the next few days. Nomura put out a note where they are expecting wholesales for Bajaj to fall 45% in the export segment at 112,000 units, and the two-wheeler industry overall will be on the weaker side. The volumes are expected to be still down about 30% from the past peak in January 2018. So not looking good at all for Bajaj Auto. But Emphasis is the other stock on our radar. Reema's here to tell us why. Reema, over to you.
Thanks so much for that. So here I'm quoting a Citi report, and this is after they met with the CFO of Emphasis, Mr. Manish Duggar, and here are the key takeaways from their conversation. one on growth. They're saying that the current environment is resulting in lower deal converting into actual revenues. So there is that bit of slowness there. In terms of Q4, the mortgage business, which is suffering for emphasis, continues to remain muted in Q4. But the good part is at least now there are no furloughs. In Q3, there were fewer working days, there were higher furloughs, but that's absent in Q4. So net on the top line, it will really be a function of how the mortgage business pans out. Secondly, on the deal pipeline, they say it continues to be healthy. They've got large deals in the pipeline. It's very diversified. They've got deals across various verticals and sectors. But the problem is it's taking longer to convert those deals into actual revenues. The sales cycles have gone up. The company indicated that they continue to remain active on the M&A front. This is something that they've been highlighting for the last couple of months. Margin guidance has been maintained between 5.25 to 17% for this year. But Citi has a sell call because valuations are at 22 times forward multiple. So they've got a sell call on Emphasis. Back to you.
Okay, thanks a lot for that. Sell call on Emphasis. The stock is down about 5%. Let's slip into a quick break. On the other side, we'll continue talking about this consumption space. One space that has done very well is travel. Lata will get chatting with Puneet Chatwal of Indian Hotels to talk about trends for the hotel industry in 2023. Stay tuned.
अरे भेज दिया डैड ने यार कहते जाओ पासबुक अपडेट करा के लाओ
मिस्टर चिंटू हेलो प्लीज प्लीज अपडेट
हाँ वैसे ये सब तो आपके ऐप पे भी दिख जाता है ना
हाँ
पापा को बताऊंगा
वो फिर भी यहाँ आएंगे
क्यों
पासबुक तो घर पे दिख जाएगा किंतु उनका जोक्स पे हंसने वाला यहीं मिलेगा
रिश्ता आपसे है सिर्फ ऐप से नहीं फेडरल बैंक योर परफेक्ट बैंकिंग पार्टनर
आग को फैलने से रोकना मुश्किल है पर नामुमकिन नहीं। अब फायरवॉल टेक्नोलॉजी के साथ सेंचुरी प्लाई क्लब प्राइम आग से बचाए।
पापा ने अपने स्टार्टअप ड्रीम को रीस्टार्ट किया ताकि मैं ये सीख सकूं सपना है तो पूरा करके दिखाओ।
करो पूरे अपने इरादे अपनों से किए सभी वादे SBI लाइफ अपने लिए अपनों के लिए
सीधे सीधे अरे नमस्ते सीधे 99 एकर्स पे है फ्री प्रॉपर्टी लिस्टिंग घर कल ही लिस्ट किया था और आज लाइन लग गई 99 एकर्स पे प्रॉपर्टी आएगी लेने वालों की लाइन लग जाएगी घर लेना हो या बेचना 99 एकर्स से ही पूछना।
My journey of insurance and investments began at the same time when I invested in LIC SEEP. In this fast-moving world, SEEP can balance your funds with security and growth. SEEP will take care of the ups and downs of the market and will give you fruitful results so that you enjoy the ride. And when SEEP is with you, you can soar high.
LIC's unit-linked insurance plan SEEP offers savings and protection so that you can soar high in your life. LIC, हर पल आपके साथ.
Ah, yes, traffic jam assist. Ta-da!
Sir, please.
Relax. Hector's got this. Told you. It pampers me.
The next gen MG Hector. It's a human thing.
With Apollo tires, have a wonderful day.
स्मिता आओ बेसो बेसो
स्कार्फ में भी पहचान लिया।
हाँ बोलो आज बैंक कैसे मनी ट्रांसफर
कर दी ऐप से
तो एफडी
ऐप से
चेक बुक चाहिए होगी नहीं है ना
मेरी शादी है ऐप में आप नहीं हो ना इसीलिए खुद काट देने चली आई।
बहुत सरस है
रिश्ता आपसे है सिर्फ ऐप से नहीं फेडरल बैंक योर परफेक्ट बैंकिंग पार्टनर।
Well, the markets may be in a bit of a dip, but that's not true of some sectors. We decided to cheer you up, so we are talking about hotel stocks. They are among the best performers in the past year, while the Sensex and Nifty have gained between 5 and 7% in year-on-year terms. Indian Hotels is up 54% on the year, Lemon Tree is up 48%, and EIH is up 25%. The hotel industry consulting company Horvath says the big story of 2022 is the rise of leisure as a vertical rivaling business. Secondly, another theme we need to discuss, Air India is placing an order for 470 planes. It appears that the hospitality industry is in for a bigger leg up in the coming years because airline and hospitality are intimately connected. To discuss the trends for 2023 in the hotel industry, I have with me, of course, the biggest of them all, Puneet Chhatwal, the Managing Director and Chief Executive Officer at Indian Hotels. Puneet, thank you very much indeed for joining us. Well, first of all, do you agree that leisure is now rivaling? It's not a subsidiary, but an independent vertical after the 2022 experience?
Absolutely. It would be fair to say that leisure across the globe and in all domestic markets has led the recovery in the sector which was demolished during COVID times. And the leisure is evolving in a very new dimension because the term bleisure was coined maybe 10, 15 years ago, but we did not see much of it. So now we see that people are combining business, leisure, taking those, building those bridges, Holy Weekend or 26 Jan weekend, and all that gets counted as leisure, but a part of that is business too.
Okay, more actual, working remotely, even that increases leisure travelers?
Yes, so a lot of people have gone back to work, to the workplace, but that option, that flexibility of working 1 or 2 days, remotely is still there, and I think that is there to stay.
Okay.
And from that as a base, leisure destinations are going to benefit.
Okay. Now let's talk business as a vertical. How much has it come to the pre-COVID levels? Has it gone beyond, and how does 23 look?
Well, the sector is back. I think pre-COVID, 1920, all the companies that you mentioned, when they report their results as their listed companies, you can see that they are already above 1920 levels. When it comes to us, we are almost at 130% plus on RevPAR recovery. And very important here is that we have opened a lot of hotels. So they are all in a kind of a settling down, stabilizing phase. So despite that, we have around what we have reported so far is 130%, which is mainly coming through rate. And when the recovery is rate driven, the profitability increases.
Okay, 1 minute. What I was asking you is, as business as a segment, how much has it recovered for you?
Business is more than 100%. For us, it's definitely gone beyond 100. I would have said around Q2, we were at 90, 92%, but we have crossed 100% also on the business.
Okay, when we speak about the MICE segment, for instance, meetings, exhibitions, conferences, that segment, has it emerged as much as it was before?
It is emerging. It was very well compensated by increase in wedding segment. But as the G20 leadership transition plus the international travel opened up, I think a lot of people are coming to India. If you look at yesterday, the German Chancellor was there. The other African delegations were there. So there is a lot of activity happening. And I am very confident that the MICE levels will far exceed 1920 going forward. And very important, Lata, here is that the key metros, Mumbai is performing north of 80% occupancy for year to date. This is not like 1 month or 1 week or a few days. And a lot of other key markets are all above 70%. There's just 1 or 2 markets which are, sub 60. But they are operating at very high rates. So it's a very positive situation at the moment, and there is nothing that I know of today which makes me feel nervous of what's going to happen in the next 3 weeks, 4 weeks, 6 weeks. The business on the books is quite strong.
Okay. So can we talk numbers? How much could you reduce the employee to guest ratio over the last 3 years because of COVID? And therefore, if you can give us some forecasts or some targets on margins this year.
I think more than reducing employees, I think the question was the sector emerged as an efficiency champion.
Okay.
And the sector actually operates 24/7, 365 days. So you don't have so much time to, put every cost under a magnifying glass and everything that you've been doing. So it was a very normal thing, including for us. What do you stop doing? What do you start doing? And what do you do more and what do you do less? And I think with that, in a high growth company like us, we were able to provide a platform for growth to our associates with all the new openings that happened, and the efficiency came in terms of room to staff ratio. To put a number to it, I think it would be fair to say anything between 15 and 20%.
Okay, so in that case, your margins, of course, in the quarter gone by improved considerably. I mean, you're at 35%. Is this maintainable? Is this improvable?
It is both maintainable and improvable, because when we announce our consolidated results, it includes assets that we own outside of India, where these kind of margins are very difficult to achieve. So a hotel in New York, or a hotel in London, or a hotel in San Francisco, Cape Town, you know, they are still not back at even 100%. So they're at 90% or 92% of what they used to be in the 1920 level. So I remain fairly confident and optimistic that next year, in Q1 and Q2 onwards, they will start contributing more than 100, like has happened on the domestic front.
Okay, so if you have to talk numbers in terms of revenues, of course, last quarter was mind-boggling. 52% growth in year-on-year revenues and 37% growth in quarter-on-quarter revenues. Are we talking like 10,000 crores very easily next year?
Our enterprise level revenue, we could say, is going to be definitely north of that number. By whether it's 15 or 20, I cannot say today, but it will definitely be at that level. But that's not the consolidated.
Yes.
That includes all the management contracts that we have, where we only report the fee income. But it's very positive, and definitely we cross that number.
Okay, and therefore, if you have to come to the EBITDA level, that as well, I think, was what? It will easily be 2,000 crores this year. Does it? I mean, you see, at 600 crores in the quarter gone by, EBITDA was up 85% year on year and 103% quarter on quarter. So it's a steaming pace of growth. What's the kind of EBITDA growth we should be reasonably?
Quarter 3, historically, and also going forward, will always be the strongest. Quarter 4 was usually the number 2. And if it maintains its number 2 position for the sector, including for us as a company, I feel if we get to 85-90% of the Q3 numbers, then we would be in a very good space. But let's see, there is still, 33 days to go.
I see, quarter on quarter is always unfair in a seasonal industry. Even year on year, 85% EBITDA growth. So obviously there were base effects as well. But still, what's a reasonable run rate?
I think reasonable run rate for a company like us, which is fast growing, we should look at a top line growth of a double-digit number, and the same number multiplied by 2, assuming a 50% conversion of incremental revenue going to the EBITDA level. So I remain that's why we have given the guidance that we have given of 33% EBITDA margin in this business cycle, knowing well that historically, 10 years ago, 15 years ago, achieving even 15 was a big thing for us.
Okay. I mean, have you also factored in a likely rise in crew rooms? I mean, if there are 470 flights for one addition for one airline, one would assume across the industry there will be increases. So how much does crew contribute to?
It depends on the
destination.
Yeah, it will be a number that will grow to around 10% for what is airline related businesses, because we are also having a 58% market share through TajSats on all the meals or
flight
hospitality
kitchens
in the air and hospitality on the ground. So I remain very optimistic that this number is also beginning to grow exponentially. It comes at a very different rate. Positioning, but it is a confirmed business for 365 days. So each hotel, each brand needs to see how much crew allocation they need to have.
Okay. And if you can give us some idea of your expansion plans, what's the latest in terms of new properties that you will build, where, and how many more management contracts are you gunning for?
Well, that's something which has been very interesting for us. We have added more than 120 contracts to our pipeline in the last 4-5 years. And we have opened, of those, already 40 properties. If we take the calendar year, the 4 quarters, we have signed 2.5 agreements a month, which means 30 plus. We think for the financial year that number will be even higher. And we have opened 17 hotels in the calendar. At a minimum, we'll open 17 also in the financial year by end of 31st of March. Going forward, I see no change because our pipeline is 70 plus hotels. So of those, at least another 40, 50 will open. And
these are management...
Almost 75% of our pipeline is based on management contracts. There is some operating leases because we changed the Ginger brand model to operating leases, and a few will be owned. In the spirit of nation building, as we've always done, putting Goa on the map, putting Andamans on the map, we're going to do that with Lakshadweep, which is a very, very important project for both us and for the nation. And we are also doing a combo hotel, a Ginger and a Vivanta in Ekta Nagar, the Statue of Unity or Kevadia. So that's at the start phase almost now.
Okay. Out of time, Puneet, but you leave us extremely optimistic about at least one sector doing exceptionally well. Markets today still a bit under the weather, but not the hotel industry. As you can see, Indian hotels, post the conversation, is rushing to up 1%. We started in the red this morning. Clearly, the investing community is enthused by what we heard. We wrap up on Bazaar on that optimistic note. Trading ideas coming up for you on Chartbusters.